Welcome back to the deep dive. This is where we take that a huge pile of information. You send us all your articles, the research, policy stuff, and we try to boil it down into something really useful, pure insight. Today, we're diving into something pretty massive. It's one of the biggest shifts, I think, happening in finance globally.
Oh, yeah? What's that?
It's this pivot, Cryptocurrency moving away from just being this speculative thing, digital gold, as they call it,
Right.
to becoming something functional, like an actual payment system you can use every day. It really changes the whole game for digital assets.
Mm-hmm.
So our mission, based on the sources you sent, is to really unpack this central question. Is using crypto to buy stuff actually smart?
Mm-hmm.
Or is it just fundamentally way too risky for, the average person, the average shop owner?
Mm-hmm.
We're definitely past the what-if stage here. I mean, look at El Salvador making Bitcoin legal tender. That's a nation-state move.
Yeah, that was huge.
And then you've got these giant traditional finance players getting involved, like PayPal launching its own stablecoin, PYUSD, PayPal USD. It's U.S. regulated too. That tells you this shift is happening, like, right now.
And digging into this is so important for you, the listener, if you want to understand what's coming next in global finance. It really is.
How so?
Well, think about it. When these digital assets stop being just things people trade back and forth on exchanges and actually start working as money, a way to price things, a way to pay for things.
The medium of exchange.
Exactly. It gives the whole space a kind of legitimacy that just speculating on price never could. The whole conversation changes, right? It goes from, is this thing going to crash, to, okay, how do we actually build the global plumbing for this?
Right. It becomes infrastructure.
Precisely. And the sources we have today are great because they look at this whole transition from all different angles. We've got the big picture stuff, policy papers from the IMF, the World Bank.
30,000-foot view.
Yeah. But then we also have really specific on the ground numbers, data on the Lightning Network's growth, for instance. And we'll look at companies getting involved, Starbucks, PayPal, Visa. How are they actually dealing with this tech?
So weighing the pros and cons.
Exactly. We need to weigh these pretty dramatic advantages, the disruption potential, against the warnings, the risks, which are very real and are right there in the source material, too.
Okay, let's get into it then. Let's start with the why. Why is this payment revolution even happening? If you put crypto side by side with the, let's be honest, often clunky old banking system.
Slow, expensive.
Bureaucratic, yeah.
Yeah.
What makes digital assets fundamentally better right now?
Well, the first thing, and maybe the most powerful argument, is this idea of borderless transactions. It's inherent in the tech, right? It doesn't care about national borders.
It's global by default.
Exactly.
Yeah.
For the first time, really, we have a way to send value instantly, anywhere in the world, without needing a bank in the middle or this whole complex web of correspondent banks.
No middleman.
Right. And that solves some really big, expensive problems that are just baked into how things work now. You try sending money overseas today.
Oh, yeah. It's a pain.
It's a mess. You hit these old systems like SWIFT, that's the Society for Worldwide Interbank Financial Telecommunication. It relies on this chain of trust between banks in different countries.
It's slow.
It's slow.
Yeah.
It often takes days, and it costs a lot, with fees from all the banks involved, plus complicated currency conversions. Often you don't even know the real cost up front. Crypto, especially stable coins like USDT Tether or USDC from Circle, these are tokens pegged one-to-one to the US dollar. They just cut right through that whole complex chain.
There's like a direct connection, bypassing all those national financial walls.
Perfectly put, a global connector.
Yeah.
And you really see why this is needed when you look at emerging markets. The sources point this out. Developables in Africa, Latin America, they often get paid in stablecoins. USDT is common.
Why's that?
To get around really restrictive local banking rules or just insanely high costs for sending money home remittances, the World Bank says the average cost to send money internationally is 6.5%.
Wow, that's high.
It is. Crypto transfers, often done for a tiny fraction of a percent, instantly. Imagine you're sending money home regularly, or you're a business working across borders. That difference is huge. It's not just nice to have, it's solving a real problem where the old system just isn't working well enough.
Yeah, that makes sense. And that idea of bypassing the old system, it flows right into the next point, doesn't it? Speed and accessibility, the whole 24/7 finance concept.
Right.
Banks have banking hours, weekends, holidays. International transfers like ACH can take 3 to 5 business days to clear sometimes.
It feels ancient in the digital age.
It does. Blockchain finance, though, it settles things in minutes, sometimes seconds. Doesn't matter if it's 3 a.m. on a Sunday. That constant availability is a massive plus in a world that's always online, always working. But, okay, that promise of speed runs into a problem with the big networks like Bitcoin, right? Scalability.
Yeah.
They can't handle tons of transactions at once,
That's the bottleneck.
which is why the sources talk so much about layer 2 solutions. This is where we get into the nuts and bolts, like the Lightning Network. This seems key for making Bitcoin usable for payments, not just storing value.
Yeah, the Lightning Network is really quite clever. It gets around the main Bitcoin blockchain's limit, which is only about, what, 7 transactions per second?
Something like that.
So Lightning lets 2 people open a payment channel directly between them. That first step needs 1 transaction on the main Bitcoin chain. But once that channel's open,
Then what?
they can zip thousands of small payments back and forth instantly and for almost no fees. It all happens off the main chain.
Okay.
Only when they decide to close the channel does the final net result get recorded back onto the main blockchain. It boosts the capacity massively, turns Bitcoin from this slow settlement thing into something you could actually use at a shop.
Right. Makes it practical for retail. And the impact of that speed and access, thinking bigger picture, it's huge for democratizing finance, isn't it?
Definitely.
You look at those World Bank numbers again, 1.4 billion people without bank accounts globally. Crypto's barrier to entry is way lower.
Much lower.
All you really need is a basic smartphone and some internet connection. It avoids the need for banks to build expensive branches everywhere. It gives people who are shut out immediate access to global financial services. They can join the digital economy pretty much straight away.
Which leads us nicely into the next theme, financial freedom and control. This is really sort of the philosophical heart of the whole decentralization idea. It's built on this self-custody principle.
Meaning you hold your own money.
Exactly. That's the key difference. With true crypto payments, you control the private keys. There's no third party, no bank, no government, no payment company that can just decide to freeze your account, take your money, or block a transaction because they don't like who you're sending it to.
Censorship resistance.
That's the term. It's built right into the tech. And that really appeals to people who, maybe don't trust big institutions or who live in places with unstable governments or shaky financial systems.
But hang on, is that freedom just another word for no one helps you if you get scammed?
Yeah.
How do the sources square that high ideal with the fraud risks we're going to talk about?
That is the central tension, absolutely. And the sources don't ignore it. They present it as a trade-off, plain and simple.
Okay.
You get freedom from censorship because it's decentralized. But decentralization means there's no central helpline to call when things go wrong. Still, when you look at where this is actually used, the value of censorship resistance in a crisis is pretty clear.
Like what?
Our sources mention aid groups using crypto in unstable countries. When the government cracks down and freezes regular bank transfers, crypto can still get through. It lets them buy essential supplies or just get money to people who need it. In those moments, it stops being just about finance and becomes a tool for, civil liberties, really.
Powerful point. And that tension kind of shows up in the next benefit too, right? Transparency and traceability.
Yeah, it's an interesting contrast. Unlike cash, which is anonymous, or traditional banking, which can be quite opaque, every single crypto transaction gets recorded on the blockchain.
And anyone can see it.
Anyone can verify it. It's a public, unchangeable record. And that totally changes the risk calculation for businesses.
Oh, so?
The blockchain gives you cryptographic proof that a transaction happened and who owns what. For a merchant, this is huge. It helps fight one of the biggest pains in e-commerce. Chargebacks.
So yeah, chargebacks are awful for businesses.
Right. You take a credit card payment, and weeks later, the customer disputes it, says it was fraud, or they never got the item. The merchant often ends up eating the cost plus fees. With a verified on-chain crypto payment, that transaction is final, immutable. It doesn't solve arguments about whether the product was any good, but it does eliminate that specific type of payment fraud where the sender later denies sending the money. Non-repudiation, they call it.
Got it. Okay, and the last benefit ties into the future. Integration with Web3. Using crypto for payments isn't just about swapping out your Visa card, is it?
No, not at all. It's about plugging you directly into this whole emerging decentralized internet. Paying with crypto is often the first step, the sort of gateway drug into the wider Web3 world.
Like DeFi and NFTs.
Exactly. Think about how efficient that could be. You use one digital wallet, which is kind of like your decentralized ID, to do everything. Pay a friend, swap some tokens on a DeFi platform, buy digital art, maybe pay for decentralized cloud storage.
All from one place.
All seamlessly. Right now, you need separate accounts, bank logins, different systems for all that. Crypto payments could potentially unify that whole digital economic experience into one smooth flow.
Okay, so that paints a pretty compelling picture. Speed, freedom, efficiency, borderless.
Yeah, the potential is definitely there.
Right. If we stop now, you'd think, why isn't everyone using this? But the sources you shared also raised some serious red flags. Huge warnings, really.
They do. It's crucial to understand the downsides.
So what are the main pitfalls? What makes paying with crypto genuinely risky, especially for just a regular person or a small shop right now?
Well, the elephant in the room is still volatility, the price roller coaster. This is the absolute core problem stopping things like Bitcoin itself from being widely used for just, buying coffee.
The price just swings too much.
Massively. The value of a payment can change dramatically, sometimes just in the time it takes to send it and for the receiver to get it or convert it.
Right.
The sources give a really clear example from 2021 adoption efforts. A shop takes a $500 payment in Bitcoin at 9 a.m. By the end of the day, maybe 5 p.m., the market's tanked, and that Bitcoin is only worth $400.
Ouch.
Or maybe it spiked, and it's worth $600, which sounds good, but for a business trying to manage inventory, set prices, pay its own bills, you need predictability. You can't run things if your income swings by 20% in a day. It makes budgeting impossible.
And that's where stablecoins like USDC or PayPal's PYUSD come in.
Right.
They try to fix that volatility.
They do try to mitigate it, yeah. That's the whole purpose. Stay pegged to a fiat currency, usually the dollar.
But that brings its own issues, doesn't it? It's a trade-off.
It absolutely is. Stablecoins solve the volatility problem, largely. But how do they do it? By being backed by real-world assets and managed by a central company.
So they depend on that central issuer.
Exactly. And on that issuer, staying compliant with regulations, having the reserves they claim to have. It solves volatility, but you often lose that core crypto idea of decentralization. You're trusting PayPal or Circle instead of trusting the code.
Right. And layered on top of volatility is this massive regulatory uncertainty. It's like a global patchwork quilt of rules.
Totally. There's just no single clear international approach. Governments are all over the map. You've got El Salvador saying, yes, Bitcoin is money.
Full adoption.
Then you've got places like China, Nigeria, India saying, whoa, slow down.
Right.
Or imposing outright bans or really heavy restrictions. Imagine you're a global company trying to use crypto for payments everywhere. It's a nightmare.
Yeah. How do you manage that? And for the regular person, there's the taxation nightmare. This seems like a huge hurdle.
Oh, it's massive. In many big economies, the U.S. included, crypto isn't treated like currency for tax purposes. It's treated as property.
Like a stock or a house.
Kind of, yeah. And that means every time you spend crypto, it could potentially trigger a taxable event. You might owe capital gains tax if the value went up since you got it.
So buying a coffee is a taxable event.
Potentially, yes. If the Bitcoin you used is worth more than when you acquired it, you technically realized a gain when you spent it. You're supposed to track that.
That sounds incredibly complicated.
It is. The sources mention this consumers and businesses would need to track the cost basis, what you originally paid for every little bit of crypto you spend, and use accounting methods like FIFO or LIFO.
Which nobody does for cash or credit cards.
Exactly. It requires specialized software, really. Doing that for hundreds of small daily purchases, it's just not practical. It actively discourages people from using it for everyday stuff.
Wow. Okay, another really critical risk getting into user safety is irreversibility. The no undo button problem.
Yeah, this is fundamental to how blockchains work. Once a payment is sent and confirmed, it's basically set in stone. It cannot be reversed. There's no central authority to step in and say, oops, roll that back.
And the consequences?
They can be brutal. You type one wrong character in a long wallet address, send funds to the wrong network by mistake.
Oof.
Poof, those funds are gone. Permanently. Irretrievably. Unlike your credit card, where you can call the bank, or bank transfers, where there are often ways to recall funds, or consumer protection rules like regret E here, nothing.
So the security of the blockchain becomes a user liability.
In a way, yes. Knowing that you are 100% responsible for every single letter and number, that's a heavy burden for people used to having safety nets.
And that finality, that lack of recourse, must be what attracts the scammers, right? Leading to scams and phishing.
Absolutely. It makes crypto a prime target. Scammers know if they trick you into sending them coins, that money is gone for good.
So they get creative.
Very creative. The sources talk about specific threats, Malicious code called wallet drainers that trick you into signing a transaction that empties your account.
Oh, wow.
Or really sophisticated phishing attacks, maybe pretending to be customer support, trying to get your seed phrase, the master key to all your funds. Because there's no fraud department to call and get your money back, the entire burden of spotting these scams and protecting yourself falls on you, the user.
Which requires a lot of technical know-how.
Yeah, a level of digital savviness and constant vigilance that, frankly, most people don't have when they're just trying to buy something quickly.
Okay, and the last big hurdle, which kind of loops back to volatility, is the adoption gap. Merchants are still hesitant.
Right. For this to really work, businesses need to not just accept crypto, but ideally hold it, use it in their own operations. But today, only a tiny fraction of businesses actually do that directly.
So how does it work when places do accept crypto?
Well, this is a really crucial point. The sources make the nuance of the fiat conversion trap. Often, when you pay with crypto, using big processors, Visa, MasterCard, even maybe PayPal's PYUSD service in some cases,
Yeah.
that processor instantly converts your crypto into regular money, dollars, euros, whatever, before they give it to the merchant.
Ah, so the shop owner never actually touches the crypto.
Exactly. The consumer pays with crypto, but the merchant gets fiat. It protects the merchant from the volatility risk, which is good for them.
But it hinders real adoption.
Precisely. The crypto is just acting like a temporary voucher, a way to move value quickly behind the scenes before it turns back into dollars. It's not being used and held as a currency itself by the business. That immediate conversion means the risk just gets passed to the processor, and it stops crypto from gaining that legitimacy as something businesses actually want to keep on their books.
Okay, so that covers the major risks: volatility, regulation, irreversibility scams, and this adoption gap fiat conversion issue.
Yeah, those are the big ones highlighted in the sources.
So, zooming out again, what does all this mean for the bigger picture? Beyond just one person losing money or one transaction failing, why should we care if crypto payments succeed or fail for the whole digital asset world, and maybe even for finance generally?
Oh, it matters hugely, primarily because of legitimization beyond speculation. If crypto genuinely works for payments, it moves beyond being just this niche speculative thing people gamble on.
It proves its utility.
Exactly. It becomes functional money, and that fundamentally changes how regulators, central banks, governments view it. It boosts its overall legitimacy in a way that price speculation just never can.
And it probably drives usage of the networks themselves.
Massively. That's the network effect. More real commerce happening on-chain, people actually buying things with stablecoins or using layer 2s daily, means much higher network activity.
More transactions, more value moving around.
Right. More fees being paid, more value locked in the system. All that activity strengthens the underlying blockchains. Bitcoin, Ethereum, Solana, whatever is being used. Plus, the scaling solutions built on top. It creates this positive feedback loop. More users, more utility, more developers, better security. That loop is vital for these systems to survive and grow long term.
And connecting this to the really big picture, if crypto payments really take off, could they actually reshape global finance?
Potentially, yes. If these new payment rails genuinely prove to be cheaper, faster, more transparent, more auditable than what we have now,
They could challenge the incumbents?
they could fundamentally reduce the world's reliance on these older legacy systems. Think about SWIFT, the correspondent banking system.
Yeah.
It's decades old. It requires banks to park huge amounts of money all over the world just to make international trade happen.
Right, it's inefficient in some ways.
Crypto payments, especially if we're talking regulated stablecoins running 247 on efficient blockchains, offer a direct, potentially much more efficient alternative path for value to move globally. It's not just a small change. It's a direct challenge to the dominance of traditional banks, SWIFT, even card networks like Visa and MasterCard for certain uses, especially cross-border. It forces them to adapt or risk becoming less relevant.
Which leads us to the path forward. Where do the sources see this heading? What are the key trends shaping the future of crypto payments?
Well, the sources point to a few key things.
Ah.
First, stability is king for payments. So stablecoins and central bank digital currencies, CBDCs, are really expected to be the main players in the payment space.
Because they hold their value.
Right. But there's a really important tension there. Governments are seriously looking into CBDCs, digital money issued and controlled by the central banks.
So a digital dollar or digital euro.
Exactly. They offer stability, sure, but they also keep control firmly centralized with the government. They can monitor transactions, potentially even program the money.
Which is the opposite of crypto's original idea.
It's a direct challenge to the private, decentralized stablecoins. So the future likely involves a kind of battle between these models. Government-run CBDCs versus regulated but privately issued global stablecoins.
Interesting. Okay, second trend.
Scaling solutions. This
Yeah.
remains critical. We talked about Lightning for Bitcoin, but layer 2, scaling across the board, things like Base, Arbitrum, Optimism, Polygon on Ethereum, they are absolutely essential.
Why essential?
Because for mass adoption, for buying everyday things, transactions need to be almost instant and cost virtually nothing, like fractions of a penny. Transacting directly on layer 1 blockchains like Ethereum can still be expensive sometimes, especially when the network is busy.
Those gas fees can spike.
Right. Layer 2s batch thousands of transactions together off-chain and then settle them cheaply on the main chain. They use roll-up tech, usually. Without that kind of scaling, making transactions super cheap and fast, crypto stays stuck as something for bigger, less frequent transfers, not daily use.
Makes sense. And the third trend.
Mainstream integration. The idea is that the underlying tech needs to become invisible to the user. People won't want to mess around with complex crypto wallets just to pay a friend back for lunch.
It needs to be seamless.
Exactly. The future probably involves crypto payments being deeply embedded inside the apps people already use every day, social media, messaging apps. The sources suggest things like paying people via Telegram or X, formerly Twitter, or WhatsApp could be the next big frontier. You'd send money without even necessarily realizing you're using a blockchain underneath. The user experience has to be dead simple.
Okay, so stablecoin SCBDCs, scaling, and seamless integration are the key things to watch.
That seems to be the consensus from the sources, yeah.
To make all this more concrete, let's look at some of the specific case studies you mentioned were in the sources. How do these ideas play out in the real world?
Okay, yeah. Let's start with El Salvador, 2021. That was just a landmark moment. First country ever to make Bitcoin legal tender.
Huge news at the time.
Unbelievable significance. It forced everyone, IMF, World Bank, other governments, to suddenly take crypto seriously as part of national economic policy. Now, the actual results on the ground have been, well, mixed.
Yeah, reports vary.
There are definitely issues with the government's Chivo wallet, and adoption by ordinary people and businesses wasn't as high as hoped, initially at least. But it's still the biggest real-world test case. It proved the borderless aspect, especially for remittances, could work at a national scale.
Right. Then there's PayPal, PYUSD. What's the significance there?
This is probably the clearest sign of institutional acceptance moving into the payment space. It's the first really big U.S.-regulated stablecoin coming from a household name in fintech.
People trust PayPal.
Exactly. PayPal brings that immediate trust and regulatory clarity that maybe some of the purely decentralized stablecoins lack for the mainstream market.
Yeah.
It signals to other big companies, okay, this digital payment idea is real, it's viable, let's get involved. It directly addresses that volatility risk we talked about within a familiar framework.
Okay. And then a very different kind of case study. Ukraine, 2022.
Yeah, this one is incredibly powerful. Right after the war started, the Ukrainian government and various aid organizations started accepting crypto donations.
That got a lot, right?
Over $100 million flowed in within just a few weeks. It was astonishing. It showcased the speed, the borderless nature, the censorship resistance in an extreme crisis situation.
When traditional systems might have struggled?
Absolutely. Regular international bank transfers might have been too slow, too complex, or blocked. Crypto just bypassed all of that and got funds directly to where they were desperately needed. It really showed its potential as an emergency financial lifeline.
Wow. And finally, going back to the adoption issue, you mentioned Starbucks and BitPay.
Right. This illustrates that fiat conversion trap perfectly. Starbucks does accept crypto in some places, yes, but the sources point out they often use a third-party processor, like BitPay.
And BitPay does the conversion.
BitPay takes the customer's crypto, instantly converts it to dollars, and gives the dollars to Starbucks. So Starbucks gets paid, the customer uses crypto, everyone's sort of happy.
But Starbucks isn't holding Bitcoin.
Exactly. They're insulated from volatility, but it means they aren't truly adopting crypto into their business finances. It remains just a payment method that gets immediately swapped out. That model limits how deeply crypto gets embedded in the economy.
So these examples really highlight the potential and the current limitations.
They do. And for you, the listener, wanting to track how this whole payment trend evolves, the sources suggest watching a few key things. First, keep an eye on top stablecoin transaction volumes. Look at USDT, USDC, and now PYUSD. Are people actually using them for payments or just for trading? Rising consistent volumes suggests real utility.
Okay, what else?
Second, monitor the growth in Bitcoin Lightning Network capacity. That's a really concrete metric for scalability. More Bitcoin locked in Lightning channels means the network can handle more small, fast, cheap payments. It's a direct measure of its readiness for retail.
Got it. And lastly,
Look at crypto adoption heat maps. Focus on regions where it's already being used heavily for real commerce and remittances, places like Latin America, Africa, parts of Asia. Often, that's where the need to bypass the old, expensive systems is greatest, so adoption happens faster out of necessity.
great practical tips there.
Yeah, those give you a real pulse on things.
Okay, so we've covered a lot of ground. We've reached the end of this deep dive. We've really tried to lay out this fundamental trade-off in crypto payments.
Yeah, it's a big one.
On one side, you've got this amazing potential, borderless, instant 24/7 finance, total control in your hands.
Freedom.
But on the other side, these huge hurdles, the crazy volatility, the mess of global regulations, that scary irreversibility, no takebacks, and the sheer headache of tax compliance.
Yeah, the case for crypto as a payment method is definitely stronger now than it's ever been. You see it being driven by real needs in emerging economies and by clever tech like Layer 2s.
But the risks are still very present.
Absolutely. Which leads us to that final provocative thought we like to leave you with, something to chew on based on everything we've discussed from the sources.
Go for it.
Okay, so think about this. Layer 2 scaling is getting better and faster, solving the speed issue. Stablecoins are largely solving the volatility issue, at least for payments. So if those two big technical problems are being addressed, what's the real long-term barrier left for mass adoption? Is it purely the regulatory uncertainty, just waiting for governments worldwide to agree on clear rules for taxes and compliance?
Yeah.
Or is the security risk of irreversibility just too fundamental? Is that lack of a safety net, the absence of consumer protection like chargebacks, simply too big a psychological hurdle for the average person to ever really get comfortable with for everyday spending?
Mm-hmm.
What do people ultimately value more, that pure decentralization and absolute self-control? Or the safety and familiarity of having some form of centralized consumer protection, even if it means less freedom?
That's a really good question to ponder. Decentralization versus protection.
Yeah. Where does the balance lie for mass adoption?
All right, that wraps up our deep dive today on the promises and perils of paying with crypto. We really hope this breakdown helps you cut through the noise and get a clearer picture of this really important shift.
Hope it was useful.
And hey, if you did get value from this, maybe understanding Layer 2s better or the tax implications, please do consider subscribing, maybe leave a comment, engage with the video somehow. It genuinely helps us out a lot, tells the algorithms people find this useful, and lets us keep making these deep dives for you.
Yeah, we appreciate the support.
We'll be back soon with another deep dive, digging into the next batch of sources you send our way. Thanks for tuning in.